Why most investors lose money, the psychology nobody talks about. Many people assume investing relies primarily on intelligence. They think successful investors possess superior information. They expect better predictions and more effective formulas. However, the greatest threat to your wealth may not be the market itself. It may be your own mindset. For more than a century, investors have repeated the same mistakes. They buy during periods of widespread optimism. They sell when fear dominates the market. They pursue short-term trends. They often panic during market downturns. They convince themselves that each situation is unique. Today, we will examine the underlying psychological factors that influence financial markets. By the end of this video, you may see that the greatest investment advantage is unrelated to stock selection. Instead, it depends on mastering your own behavior. Chapter 1. The market is a mirror of human emotions. Every day, millions of people buy and sell stocks. Most people believe that news drives price movements. Economic reports, interest rates, and company earnings are also considered important factors. These factors matter. However, these factors do not explain all market movements. In reality, short-term market movements are often driven by investor psychology. Emotions such as fear, greed, hope, and regret play a significant role. When investors become optimistic, prices rise. When investors become fearful, prices fall. The market is not simply a machine that calculates value. It acts as a large emotional voting machine. Human emotions rarely move in a straight line. This explains why markets often overshoot. Stocks become too expensive during bull markets. They often become undervalued during bear markets. Investor sentiment swings between optimism and pessimism. This cycle repeats itself again and again. Chapter 2. Why people buy at the top. Consider the typical progression of a major bull market. At first, very few people believed it. Investors remain cautious. News headlines are skeptical. Most people wait for a pullback. Prices continue to rise. More investors become interested. Media coverage shifts to highlight new opportunities. Individuals begin sharing personal success stories. Profits seem easily attainable. Confidence grows. Eventually, a critical risk emerges. Investors stop evaluating whether an asset is worth purchasing. Instead, they focus on potential returns. This shift in mindset often marks the beginning of a market bubble. History has shown this repeatedly. The dot-com bubble, the housing bubble, cryptocurrency manias, meme stocks, different assets, same psychology. The majority becomes convinced that prices will continue to rise indefinitely. Ironically, this is often when the greatest risk emerges. Chapter 3. Why people sell at the bottom. Let us consider the opposite scenario. The market crashes. Headlines become negative. Experts predict disaster. Investors see losses in their accounts. Fear begins to spread. At this stage, most investors do not ask themselves, "What is this asset worth?" Instead, they ask, "How much more can I lose?" This is a critical difference. Fear changes the questions we ask. As a result, the answers are often distorted. History demonstrates that the most significant investment opportunities often arise during periods of heightened fear. March 2009, March 2020, many previous market crashes. The most attractive buying opportunities seldom feel comfortable. In fact, they often feel intimidating. When others are selling, emotional responses can strongly encourage you to follow suit. Investors frequently hear a familiar phrase. Everyone says, "The economy is doomed." Everyone says housing will crash. This stock is going to the moon. Inflation will destroy everything. The challenge is that everyone is often late. By the time a belief becomes popular, most opportunities have already passed. Markets constantly look ahead. They price in future expectations, not current headlines. As a result, the crowd often reacts after the market has already adjusted. Successful investors recognize an important principle. The market rewards independent thinking, not stubborn thinking, not contrarian thinking for its own sake. Independent thinking. It is the ability to assess facts independently without being influenced by the crowd. Chapter 5. Your biggest enemy is not the market. Many investors spend years searching for the perfect strategy, indicator, stock, or economic forecast. The perfect indicator, the perfect stock, the perfect economic forecast. However, they often overlook the greatest risk, themselves. The market does not consider your purchase price, hopes, or opinions. The market does not care about your hopes. The market does not care about your opinions. It simply moves. Your responsibility is to respond rationally. This can be challenging, as ownership often leads to emotional attachment. We tend to seek information that supports our beliefs and ignore evidence that contradicts them. We ignore evidence. This leads to bias, known as confirmation bias, which undermines investment performance each year. This is known as confirmation bias, and it destroys portfolios every year. Successful investors separate their ego from their investments. They admit mistakes, adjust their views when facts change, and focus on probabilities rather than certainty. They change their minds when facts change, and they focus on probabilities rather than certainty. Chapter 6. The Real Secret of Successful Investors. What distinguishes successful investors from unsuccessful ones? Not IQ, not education, not access to secret information, not expensive software, not a Wall Street office, and not the ability to predict the future. The answer is simpler: discipline. This may seem disappointing. Many people expect investing to be complicated. They look for hidden formulas, secret indicators, unique insights unavailable to others. But history tells a different story. Some of the smartest people in the world have lost fortunes in financial markets. Meanwhile, many ordinary investors have steadily built substantial wealth through patience and consistency. Why? Because investing is not primarily a test of intelligence. It is a test of behavior. Consider two investors. The first spends hours every day watching financial news. He follows every headline, every economic report, every analyst prediction, every market rumor. He constantly reacts to new information. He buys when excitement rises. He sells when fear appears. He assumes that activity leads to progress. The second investor follows a different approach. She studies businesses, builds a plan, diversifies her portfolio, invests regularly. She then allows time to work. She does not react to every headline. She does not panic during corrections. She does not become euphoric during bull markets. 10 years later, who is more likely to succeed? In many cases, it is the second investor, not because she knew more, but because she made fewer mistakes. This is one of the most overlooked truths in investing. Success often results less from extraordinary actions and more from avoiding costly mistakes. The market constantly tests emotional control. When stocks are soaring and everyone around you is making money, greed begins to whisper. Invest more. Take more risk. You are missing out. Everyone else is getting rich. These thoughts feel logical at the time, but they often appear near the end of major bull markets. Then the cycle reverses. Prices fall. Headlines become negative. Panic spreads. Now fear takes control. Sell before it gets worse. Protect what is left. The market is broken. Again, these thoughts feel logical, but they often appear near market bottoms. This is why investing is so difficult. Actions that feel safest are often the most dangerous. Conversely, actions that feel uncomfortable are often the most rewarding. Warren Buffett once said that successful investing requires the temperament to control emotions, not superior intelligence. And history proves he was right. Consider some of the greatest market crashes in history. The crash of 1929, the financial crisis of 2008, the pandemic panic of 2020. Each event created enormous fear. Many investors sold at precisely the wrong time, not because they lacked knowledge, because they lacked emotional control. Those who remained calm often recovered. Those who panicked often locked in permanent losses. The same principle applies during booms. the dot-com bubble, the housing bubble, cryptocurrency manias. Speculative frenzies appear different on the surface. But underneath, the psychology remains the same. People become convinced that the rules have changed. They believe prices can only go higher. Risk seems to disappear. Caution seems unnecessary. Then reality returns. Many fortunes disappear as well. The investors who build lasting wealth understand something important. The goal is not to be right every time. The goal is to survive long enough for good decisions to compound. They do not need extraordinary returns. They do not need perfect timing. They do not need to find the next miracle stock. They simply avoid extraordinary errors. They avoid excessive debt. They avoid panic selling. They avoid chasing hype. They avoid risking everything on one idea. And because they avoid catastrophic mistakes, they remain in the game. This may seem unexciting. However, wealth creation is often unexciting. The financial media celebrates dramatic success stories. The trader who turns $10,000 into $1 million. The entrepreneur who becomes a billionaire overnight. The investor who found the next Nvidia before anyone else. What rarely makes headlines are the millions of people who quietly build wealth year after year. They save consistently, invest regularly, remain patient, ignore noise. They allow compounding to drive growth. In the end, investing is not a competition against the market. It is a competition against your own emotions, your fear, your greed, your impatience, your desire for certainty in an uncertain world. Master those emotions, and the market becomes much easier to navigate. Fail to master them, and even the best investment strategy may not save you. Because the greatest edge in investing has never been intelligence. It has always been discipline. Conclusion: markets will rise. Markets will fall. New bubbles will emerge. Market crashes will happen. Technology will advance. Governments will evolve. The economy will evolve. However, human nature remains consistent. Fear, greed, hope, regret. These emotions have influenced markets for centuries. They will continue to shape markets in the future. The greatest investment advantage is not a secret stock. It is not a prediction. It is not a formula. It lies in understanding human psychology, including your own. Once you learn to master your emotions, you stop reacting like the crowd. That is where real investing begins. Once you learn to master your emotions, you stop reacting like the crowd. That is where real investing begins. If you found this video valuable, please subscribe to The Illiterate Investor. Here, we do not follow hype. We focus on understanding markets, building wealth, protecting capital, and making better financial decisions. One lesson, one investment, one step at a time.